Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Behavioral Finance, understanding how psychology impacts financial decisions. Are your financial decisions as rational as you think? The truth might surprise you. Behavioral finance is a fascinating field that blends psychology and economics to explain why people sometimes make irrational financial choices. This video breaks down the basics of behavioral finance, showing you how mental biases and emotions can impact your investments and spending habits. Understanding these concepts isn't just academic, it's crucial for making better financial decisions. Ready to see how your mind influences your wallet? Let's get started. The foundations of behavioral finance. Behavioral finance is an intriguing field that challenges the assumptions of traditional finance. It blends psychology and economics to uncover why people often make irrational financial decisions. By understanding these concepts, you can better navigate your financial future. Let's dive into the key principles of behavioral finance. Traditional finance versus behavioral finance. Traditional finance assumes that people always act rationally and have access to all the information they need to make sound financial decisions. It relies on models such as the efficient market hypothesis, EMH, and modern portfolio theory, MPT. These models suggest that markets are always fair, stock prices reflect all available information, and investors make choices to maximize their returns. Behavioral finance, on the other hand, argues that people are not always rational. It considers the role of psychological factors and biases in decision-making. Here are some ways traditional finance and behavioral finance differ. Rational behavior. Traditional finance assumes rationality, while behavioral finance acknowledges emotional and cognitive biases. Information processing. In traditional models, all information is efficiently processed by the market. Behavioral finance points out that people often misinterpret or ignore information. Market efficiency. Traditional finance supports the idea of market efficiency, implying no consistent opportunities for excess returns. Behavioral finance suggests that markets can be inefficient due to human errors and biases. Key theories in behavioral finance. Several key theories form the backbone of behavioral finance. These theories help explain why people make financial choices that seem irrational. Let's take a closer look at some of the most significant ones. Prospect theory, developed by Daniel Kahneman and Amos Tversky. This theory shows that people value gains and losses differently. People are generally more sensitive to losses than they are to gains, a concept known as loss aversion. For example, losing $100 feels more painful than gaining $100 feels good. Mental accounting, introduced by Richard Thaler. Mental accounting refers to the tendency of people to categorize and treat money differently based on subjective criteria. For instance, you might be more willing to splurge with your tax refund, considered bonus money, than with your regular paycheck. Behavioral portfolio theory, BPT. This theory suggests that people build portfolios based on layered needs and goals. Instead of focusing solely on risk and return, they consider psychological factors. For instance, an investor might create separate buckets of investments for retirement, education, and emergency savings, each with different risk profiles. Understanding these foundations can help you become more aware of the biases that might influence your financial decisions. Keep an eye out for these patterns in your own life. Recognizing them is the first step toward making smarter choices. Cognitive biases and heuristics. When it comes to making financial decisions, our brains often take shortcuts. These shortcuts, known as cognitive biases and heuristics, can lead to less than ideal choices. By understanding these psychological factors, you can better navigate your financial journey. Common cognitive biases. Cognitive biases are systematic patterns of deviation from norm or rationality in judgment. Here are 3 common ones that often affect financial decisions. Overconfidence. This bias happens when someone has too much faith in their knowledge or abilities. For example, a person might believe they can predict stock market movements better than they actually can. This can lead to taking on too much risk, making poor investment choices, or ignoring advice from experts. Anchoring. Anchoring is the tendency to heavily rely on the first piece of information received, the anchor, when making decisions. In finance, this can mean sticking too closely to initial prices or values. Imagine you're buying a stock that initially costs $100 and then it drops to $50. Because your initial anchor is $100, you might have unrealistic expectations about its potential to rebound, affecting your buying or selling decisions. Confirmation bias. Confirmation bias involves favoring information that confirms your pre-existing beliefs or opinions. If you believe a particular stock will do well, you might pay more attention to positive news and ignore warnings or negative reports. This can lead to an unbalanced view and poor decision-making. Heuristics in financial decisions. Heuristics are mental shortcuts that simplify decision-making but can also lead to errors. Here's how they can affect financial judgments. Representativeness heuristic. This involves judging the probability of an event based on how similar it is to an existing stereotype. In finance, this could mean believing that a good company must be a good investment, even if the stock is overpriced. Just because a company is well known, like a tech giant, doesn't mean its stock will always go up. Availability heuristic. This is when people make decisions based on how easily they can recall examples. If you constantly hear about successful investments in tech stocks, you might think investing in tech is a surefire way to get rich. This can lead you to ignore other important information, like market conditions or diversification. Affect heuristic. This is when your feelings about something influence your decisions. If you have a positive feeling about a company because you like their products, you might overestimate the potential success of investing in it. Your emotions can cloud your judgment, leading to biased financial choices. Understanding these biases and heuristics can help you make more informed and rational financial decisions. Recognize these patterns in your thinking and take steps to counteract them. This awareness can lead to better outcomes in your financial life. Applications of behavioral finance. Behavioral finance has profound applications in the financial world. It helps us understand how emotions and psychological biases affect financial decisions. From investing to corporate finance, and even the broader financial markets, the impact is significant and multifaceted. Behavioral finance in investing. Investors, both individual and institutional, are heavily influenced by behavioral factors. These factors can lead to decision-making that deviates from the rational models proposed by traditional finance. Individual investors. Overconfidence bias. Individuals often overestimate their knowledge or ability to predict market movements. This can lead to excessive trading and risk-taking. Loss aversion. Fear of losses can make investors hold on to losing stocks for too long. They might also sell winning stocks too quickly to lock in gains, missing out on further potential profits. Herd behavior. People tend to follow the actions of a larger group, even if those actions are irrational. For example, during a market bubble, individual investors might buy overvalued stocks just because everyone else is doing it. Institutional investors. Anchoring. Professional investors might anchor their decisions on past reference points such as previous stock prices or historic benchmarks. This can lead to inertia and suboptimal investment choices. Confirmation bias. Institutions often seek information that confirms their preconceptions. This can result in reinforcing poor investment strategies. Mental accounting. Even large institutions compartmentalize funds in ways that might not be optimal, such as treating certain funds as sacred and untouchable, even when reallocation could be beneficial. Behavioral finance in corporate finance. Corporate finance decisions are also susceptible to behavioral biases. These decisions impact mergers, acquisitions, capital structure, and even everyday financial operations. Overconfidence in management. Managers might overestimate their ability to generate returns on new projects, leading to overinvestment and misallocation of resources. Risk perception. Companies often struggle to assess risk accurately. For instance, managers might avoid projects with uncertain outcomes due to fear of loss, even if the potential rewards are high. Short-term focus. Behavioral biases can cause managers to focus on short-term gains at the expense of long-term profitability. This is often driven by pressure from shareholders or personal incentives. Mergers and acquisitions, M&A. Behavioral finance explains why many M&A deals fail. Overconfidence and hubris lead to overpaying for acquisitions, while confirmation bias can cause ignoring due diligence red flags. Capital structure decisions, managers' perceptions driven by biases, influence how they decide between equity and debt financing. Loss aversion might make them overly cautious about taking on debt, even when it's the cheaper option. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.